All right. Well, welcome everyone. I'm Jess Huber, VP of Member Experience and Partnerships here at Mass Bankers. Today's webinar, Maximizing Channel Performance, Tackling Optimization Challenges, is presented by one of Mass Bankers' newer associate members, EngageFI. EngageFI is a technology-enabled consulting firm that partners with banks and credit unions to navigate complex technology decisions, specializing in core conversions, vendor negotiations, and digital transformation. Through a combination of strategic advisory, vendor benchmarking, and hands-on project management, EngageFI helps financial institutions modernize systems, reduce risk, and optimize costs, delivering measurable savings while supporting initiatives such as technology selection, mergers and acquisitions, and data automation to improve overall operational efficiency. Leading today's program is Fabio Biasella. Fabio is the Director of Strategic Services at EngageFI and is a recognized thought leader in retail banking with over 35 years of experience advising community banks and credit unions. A frequent keynote speaker, he specializes in strategic planning, marketing, data analytics, and digital banking, having led more than 200 planning sessions and held executive roles at high-performing institutions. At EngageFI, Fabio helps organizations translate strategy into actionable plans through board planning, scenario analysis, and executive roadmaps that drive growth and measurable results. Fabio's full bio is linked in the original invitation that we sent around for this event. A couple quick housekeeping notes. This session is being recorded. The recording and access to the recording, as well as the deck being used, Engage will distribute that around to everybody after the session has concluded. In terms of questions, we highly encourage them. You can use the chat functionality at the bottom of your screen. There's also next to it a raise hand button. You can use that as well. We'll be monitoring and we'll be addressing questions as they pop up. So with that, I will turn things over to Fabio.
Wonderful. Thank you, Jess, and good afternoon, everyone. Thank you for attending the webinar today. And for those who might be watching the recording later on, thank you very much as well. As Jess mentioned, I am Fabio Biasella. I am the Director of Strategic Services at EngageFI. I've been at this a while. Largely my specialty here at EngageFI is to help clients answer the upfront strategic questions as they contemplate, driving their organizations forward. And of course, a key component of driving organizations forward that I'm seeing now is what we will call, broadly speaking, the modernization of the tech stack across the entity and across the industry, and how that modernization can help fuel efficiency. So I'm going to share some of the highlights of what we've been seeing today and why we're seeing it and why it's important. And share as well as highlights of a case study for an institution we did in the Southeast last year, helping them begin to really untangle and optimize the way their customers were interacting in their channels. So that's the kind of the broad strokes of what we'll talk about today. Again, I will offer up, as Jess did, that please ask questions throughout. This is far better even if it's in the chat. We'll pause and answer the questions as we're going forward. Just highlighted all the things we do. I think the best way to understand EngageFI is it's not only a technology enablement company where we help you ensure that you're getting the best features and benefits in your technology packages, along with the best terms in the contract, and then deploying those things. My group specifically is tasked with helping clients design or dust off or focus whatever strategy they're trying to achieve with that technology enablement. So it is really kind of the best bringing together of all the worlds, if you will, from what we're trying to do and aligning our resources to doing it. So today's topic, as just mentioned, is going to be the wonderful world of operational efficiency, and I can think of nothing better to talk about at the noon hour with bankers than efficiency. It is a continuing and growing concern in the community FI space. For those of us who are perhaps less familiar with the efficiency ratio, ostensibly it's what it takes to generate a dollar's worth of revenue at your bank. So it's measured as a percentage, and it works much like a golf score in honor of the Masters, which is taking place right now. A lower efficiency ratio is better. It basically means that we are generating a dollar's worth of revenue more effectively over our expense structure than other institutions. So you kind of take a look at the efficiency ratio, which is a standard metric out in the industry, and you look globally at all the banks in the system. And there's about 4,800, 4,700 banks left as of the running of this data. That number changes, of course, quarterly. We only have about 1,100 of the banks out in the network in the United States who have an efficiency ratio of 55% or less. Fully 60 to 75% of the total banks in the system have a ratio of 65% or more. All right, think about that for a moment. It takes a certain number of banks 55 cents to generate the same dollar of revenue that it takes the overwhelming majority of banks to generate at 65 cents. So a real kind of divergence in the efficiency ratio starts to set up an indicator of our ability to sustain performance and grow. And it's more than just a function of being frugal, as I will say in the most euphemistic way possible. It's about how you're organizing and setting the expense structure effectively to generate the revenue. And then for Massachusetts, of the, I think, 90 or 100 or so banks with a Massachusetts charter, you can see that just 7 of them have that efficiency ratio of 55% or less, which is really a strong indicator of performance historically. And 73, or again, 3/4 of roughly the 100 Massachusetts banks that are chartered in the state have that ratio that's above 65%. So a real opportunity for us to begin looking at this ratio and the key drivers of it. And I'll talk about some of those forces here in a moment and why it's important. So, again, one of the reasons why we see clients turning to kind of expense optimization or efficiency optimization across their channels is because the profit margin squeeze is real. I'm certainly not sharing anything here that from most organizations they aren't feeling acutely at this point, as the last several years post-COVID in particular have unfolded. We've dealt with the rising rate environment, the loss of service charge income, and changes to our investment and insurance income or trust income for many shops. So revenue pressure as competitive forces put brakes on our ability to generate revenue. Meanwhile, expense pressures are rising, not the least of which is around the technology spends that many clients that have currently or are in need of maturing to keep up with the rising consumer expectations, both consumers and small businesses, the need to drive towards more effective digital support while still maintaining the highest levels of risk and compliance and safety and soundness, have really conspired to force many clients to begin looking at that, their infrastructure in a much more forceful way, not just to look for cost savings, ladies and gentlemen, but to look for the next generation of enablement. And I think that's one of the themes that I want to make sure emerges from this conversation. When we engage with clients, this is not simply an exercise in reducing headcount or figuring out how to cut each expense item on the line, each expense line item on the P&L by X% to back into an efficiency ratio. It's really more of a focus on two things. It's focus on what you're getting for the spend in terms of your ability to enable additional features and benefits that the consumers and small businesses say they need, and then how those customers are flowing through your operational systems looking for opportunities to remove redundancies and or consolidate processes. And I've got some examples of that for you. So this setup will continue in the not too distant future. And for the not too distant future, I don't see a recipe where it changes. In fact, you can begin to see how it is, impacting when you look at the actual numbers for revenue growth rates and expense growth rates spread across asset tiers. I always like to look at asset tiers just to see if we see massive differences between large institutions, and by this definition, I'm using $10 billion plus institutions to the billion to 5 billion institutions as well. So you get an idea amongst the larger size shops, do you see much variation in revenue growth and or expense growth? On the revenue side, the rate cuts, you see the rate cuts that we even have had in the first part of last year will have improved revenue growth. But that's coming off of the 400 basis point decline that or increase that we all suffered, excuse me, in 2024. The thing that I stress to clients here is if we're waiting for interest rates to fall again precipitously to return revenue growth to what it was, or to spur our overall growth in deposits and loans, I don't think that's a viable strategy anymore. There are a lot of forces at play. We're experiencing them directly more and more through the passing quarters, which would suggest that that's not the case at all. On the expense side, the expense growth, wider variation in the $10 billion shop than we typically see in other asset sized institutions, but everything is now normalizing around a regular level of expense growth against the fact that revenue growth now is no longer going to be bolstered by interest rate cuts. So we have to really sharpen our pencil in developing business with our customers, both consumer and small business, going forward. And then the last real kind of main important thing is that you do see fee revenue falling as a percentage of total income across the asset categories, with the larger asset sized institutions retaining a slight edge in the overall level of fee income contributions. But the phenomena that we talked about on the revenue growth side in terms of fee income, plainly evident across the board in the banking industry over the last 5 years. So again, kind of just supporting the original thesis with some data as I want to do. The other thing that I think is most important for us to understand as we're looking at this is, why is all of this happening? A large measure of the thrash that we've experienced, or the thrash that we're seeing across all our institutions, not just financial services, but public institutions, public policy institutions, is due to the changing demographics. The demographic changeover, the end of the baby boom generation as a driving economic force, cannot be underestimated. And I do think clients still underestimate that. And that's very important, because much of the infrastructure that we have built, ladies and gentlemen, whether we like it or not, has been built largely to cater to that group, to the boomer group, the largest, most upwardly mobile, wealthiest generation in human history, is now fully exiting stage left. And we need to take a long, hard look at our technology posture and our infrastructure and cast a new efficiency argument in light of the subsequent generations that are coming downstream, which do not look like the boomer generation, everyone. Gen Xers are too small as a group to have the kind of major economic thrust. Doesn't mean we're not important. I'm one of them, but there's 4 to 5 million less Gen Xers than boomers. And that's a lot of missing income when you do the math. Then you've got the millennial generations and the Gen Zs and the Gen Alphas, who are younger and perhaps larger than the Gen X generations, but decidedly different patterns of behavior, much more digitally driven, and sometimes not even coming into the branch at all, or whatever branch centricity they have tends to be more around service rather than sales, or the picking up of a sales opportunity that was started digitally is also very common. So I encourage you to go back and as you're thinking about efficiency at your shop and your infrastructure at your shop, it's imperative that you know what your demographic breakdown looks like. And for many banks, for many community FIs, it still tilts severely towards the boomer generation. And that is a real challenge in terms of getting younger, and how do we mature our infrastructure to begin to cater to those younger demographics. A couple other key points that I just like to mention, making this important, is that we are reaching peak 38-year-olds and peak 18-year-olds within the next 5 years. So I think around by 2031, 2032, the number of 38-year-olds and the number of 18-year-olds that we have, the seeding cohort groups, will fall in total number. So you'll have less of the two key kind of younger components that we'll need to build our business and grow going forward. We have to be aware of that. So, knowing the number of 38-year-olds and knowing the number of 18-year-olds that are in your system, and kind of reverse engineering conversations with their boomer parents, is something that I see growing, and I see infrastructures trying to figure out how to accommodate. So a lot of forces at play, suggesting that we need to take a long, hard look at our tech infrastructure and our efficiency. And okay, so that's great. We know what's going on. We have an understanding. One of the main problems that when we get in and start looking with clients, everyone, is what I'm calling historical channel proliferation. So, this is a longitudinal look at when banking began in the country, and the channels that we have added historically. You can see. Make sure I build this out here. Yeah, there we go. We started with branches, as we all know, right? And we added call centers in the 60s. Then we added ATMs in the 70s and 80s, all of which was supposed to start to mitigate the realities of having a branch network. Then we began to add all the digital framework, online banking, mobile banking in the 90s and the early 2000s. And now all of the digital features that go on to a mobile experience: account opening, loan origination, money movement, the full mobile wallet environment. When you look at the channel proliferation this way, most clients, when we get in and work with them, have added the channels in individual silos, ladies and gentlemen. And that siloing of resources and talent has led to, I think, some of the challenges that we're going to be talking about today, and how quickly clients can move forward. So again, another step that I encourage you to take is think about this level of siloing effect inside your organization, and how well they're able to speak to one another, and move across one another, because we have to begin to, if we're going to modernize our technology posture and the way we interact with customers, breaking down the silos across the channels is a key component, strategic component, that clients have not seen this kind of clarity en masse. So I encourage you to take a look at that. But it is fascinating to watch how call center is added to branch, ATM staff and digital staff is added to the call center and perhaps to the branch. And now a whole separate mobile and or digital banking department emerges as well. So again, as we're adding the channels, right, what happens in the early 90s is we begin the drive towards centralization. We realize we have this burgeoning branch network. It is the primary sales conduit. So we begin to centralize things which had historically taken place in the branches to free them up to quote unquote sell, okay, or handle transactions, process transactions, the historical teller line phenomena taking place. As we've done that, right, we move further things to the back office in silos, typically into those silos that we saw, and oftentimes, and then have to staff and deal with them accordingly. right? The problem now, right? Again, hearkening back to the demographic switchover, is when you begin to examine channel preference or channel use across the generational segments, you can see the problem emerging in the younger segments, the Gen Z segments, particularly with their use of branches. Okay. They offer the lowest projected channel branch use. And I don't know if I have a markup tool here. I think I do. Yep. Out of all the segments, right? And they're coming into the branch still, but they're coming in less to do transactions now and more to ask about service or sales questions, which is a good thing, but they're only coming in once. Whereas you look at prior generations, millennials, Gen Xers, and certainly boomers, they come in more often, generally speaking, maybe perhaps 2 to 3 times a month. And all of us have a story at our bank of the Boomer Plus customers who visit us routinely 2 to 3 times a day, but they are exiting. And we're, as a result, our infrastructure at the branch side is becoming increasingly underutilized. And we'll see some of that going forward. But you can see the other channels as they proliferate, the use of mobile banking by the younger demographics as well, and even online banking by the boomers is still there. So channel proliferation has taken place. Oftentimes our customers are going to the electronic channels first and foremost, and perhaps not coming into the branch locations as much as we should. So that begs a couple of very real questions on the efficiency side. How strong is our digital infrastructure to create the kind of experiences we want? And what's going to be happening as transaction counts at the branch continue to fall? With or organizational efficiency. Okay, so clients will call us in because they're seeing these things. They've got a problem on the digital front that they need to address to create a better experience or create some additional features and benefits. And they have a branch structure which is increasingly underutilized. Now, there's a couple of ways to do this, right? Many consultants or many institutions will simply start taking the line item look on the left side and take an expense focus pass at efficiency. While it's worthwhile, I think it's one-dimensional. You want to make sure that you're doing more than just trimming expenses across categories, the proverbial tightening of the belt. You're wanting to make sure that the resources that you have available and the processes that you have available are being allocated differently or properly, and you're actually seeing process simplification and the elimination of redundancy where appropriate. You do get to some of that in many instances, but the other pieces that I would recommend would be taking a customer focused look at your tech, at your infrastructure and your processes. So not just cutting expense and rearranging assets to improve processes, but looking at how the customer experiences your processes and then simplifying and or removing the frictions to create a better experience. And then perhaps rearranging features and benefits and services that take advantage of the excess capacity that's increasingly appearing in branches. So far, so good. Any questions? I want to make sure that we take a breath. Otherwise, you guys are, just inundated with having to listen to me. If there are any questions, please do. Please ask. Okay. So the main thrust as you start down this road of understanding efficiencies, you're looking both back and front. The reality is for most banks, branches still matter, right? The simple answer as you go through the expense reduction and headcount is you start finding your least profitable, least productive branches and you start closing them. Well, that's not really practical for many banks. First and foremost, for CRA purposes, we tend to be loath to close institutions, and rightly so, or locations, and rightly so. But there are other reasons why it's still important. First and foremost, when you ask any consumer or small business if having a branch nearby is one of the key factors or primary factors in choosing a bank, it still is. It's still cited if not the number one factor, it is number two for all of the segments and many small businesses. So the need for physical presence, even if the consumer never really uses it, they do tend to value having a branch nearby. It's the branch as a lifeboat phenomena taking place. So you're not going to be able to get rid of your branches. You're still desirous of being able to mine your local market through the branch network. The branch as a billboard has a lot of value, both for business, for future business and brand awareness. I'm sure many of you, if you were to heat map your customer base, would find that it's highly branch centric. That still remains true for many institutions, even if those people who are highly branch centric never set foot in the branch. So you still have checks despite the long history of checks going away. We still have a lot of checks in the system that need to be dealt with, and the fraud that's associated with mobile deposit and the restrictions we put on sometimes forces people into those channels as well. So so we're in a bit of a conundrum. We have a branch network we built for a generation that's phasing out. We need to right size that branch network, but we can't necessarily do that by closing a lot of locations. So we need to do two things. We need to figure out on the branch side how to reinvigorate those locations to cater to the next generations, and do that through sales and service, and then utilize the excess capacity that's going to sit in those branches because we have to staff them. Appropriate safety and soundness suggests that we need somewhere from 3 to 4 people per location to maintain staffing and deal with vacations and provide dual control, all the historical stuff. So many clients have moved to that universal banker model to help do that. But even with just 3 to 4 people kind of staffing a location for many clients, a retail location in particular, there's still not enough transaction count to justify those numbers of bodies. So we need to begin to address those issues as well. So with that in mind, you reach a tipping point, right now over the last 5 years, with all these underutilized people. So what do we see clients doing? Well, after you move to Universal Banker, which is a key consideration if you haven't done it, you start seeing things that were once centralized, like call center activity, overflow in particular, being decentralized back out to the branches and utilizing those call center staffs to handle those types of functions, as well as the outbound calling efforts. Many clients have moved to outbound calling with key personnel located inside of their branch facilities. So that's the step one in kind of getting things to a better spot for utilizing the staff that we have. So we've looked at that area. We're going to look at it in conjunction with backroom offices. So that's kind of setting the lay of the land, if you will. Spend the last 15-20 minutes here looking at the particular case study. So this particular institution, a decent sized shop in the Southeast, had 36 branches, 500 employees, had made a lot of acquisitions through the years, and was beginning to have an income or performance gap compared to other institutions its size, simply due to the rapid growth and the accumulation of the branch network for all the reasons that we just kind of described to you, right? So we get in there and we start helping them uncover the pain points and understanding what's going on. And we find that only a quarter of the branch employees are fully utilized based upon the transaction counts. In addition, this client had 4,000 overflow calls per month that they were sending to an outside party to help cover, again, because of the clumsy processes. And that resulted in pretty awful numbers at the call center in terms of abandonment rate and wait times. So as you can imagine, that was starting to create a lot of angst, and it was starting to slow the growth for the organization because their experience was varied by channel, to say the least. So that kind of sets the land for this organization. Again, this is a typical shop what we encounter, has grown through time and acquired those channels and silos through times, and really needs to take a look at both the front end and the back end and how they're working together. And so when we get in there, we start to do a bunch of things. And again, not just going by line items, looking for ways to reduce headcount. We tie everything back to what the transaction volumes are for the front end of the location, and then the customer experience on the back end that we were putting them through. Now, this is an incredibly busy chart, but ostensibly is a roadmap of what was happening to this customer, to this client's customers, depending on the channel they came in for a loan application. Okay. And the blue areas here, 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 and here, and here, all were subject to a different process, right? So if the customer came into a branch to make a loan application, it was a straightforward process into the system and then a loop through for approval or denial or fulfillment. If they came in from their digital systems or anything but the branch, the physical employee, the customer went on a decidedly different path. Oftentimes being routed to a special team of individuals designed to handle the request that weren't the branch staff and could not be handled by the call center. So right off the bat, you see how they solved a short-term problem as their call center developed by creating a special group of people to handle the calls, if you will, and then never bothered to adjust the process. So as a result, lots of clients were coming into through the digital channels and whirling about for quite some time, and then made their exit to hopefully the system. But a lot of applications were never being fulfilled. So this is the kind of customer-centric approach that I encourage you to take. How does your customer experience each of your channels? Map it out like this. Well, we were able to do this for this particular client and offer a much more simplified approach that basically eliminated that special team. In this case, I think it got up to 12 people, and simply reassigned some of those folks and re-engineered the queuing process for them so that irrespective of channel, it was coming in to a queue, going to the branch regions. Okay, so we moved that loan discussion back out to the branch staff to have and facilitate, which then mirrored the experience the customer was having by coming into the branch. So again, a pretty big effort, but this change alone, or this change alone, greatly improved the throughput capability and freed up 12 slots of individuals to either be sunset through attrition or rerouted to other areas of the institution that needed it. So again, and you could do this. We did this for loans, but we did this for every experience they have, and you can get a really good picture of what you're putting your customers through, and the heroic nature oftentimes that we ask our staff to take to shepherd our customers through this process. So with this, you're armed with the ability then to go and say, okay, how does my tech infrastructure need to change to accommodate these types of things? Because you know what you're going to change and what you want to accommodate. Then, in addition to looking at all the backroom office activities and the customer experience, we took a look at the branch network itself, comparing transaction counts, sales volumes, types of customers being served, types of markets that they were in, and ostensibly gridded out the entire network for what we'll call market potential. And how well the branch was performing against that market potential. So, and again, this will be germane to each of your organizations. High potential shops in the Southeast will look quite a bit different than high potential shops in Massachusetts, for example, both in nature and in number, just the sheer shape of the geography. will help drive some of that. But we did this effort where we graded out all of the shops into this quadrant. And then what this let us do is not rationalize the closing of low potential or low performing shops, but when we went to start to decentralize, if you will, call center activity or loan application activity that was coming in from the digital channels, you could begin to shuttle some of that excess capacity into the branches that you weren't able to close because you needed to keep them for whatever reason, that maybe had lower potential and or lower performance slash utilization. So it's a way again to take up that excess capacity and use it efficiently. In addition, then if you're wanting to just to decentralize even more loans, loan processing, loan underwriting, you could then begin to use this framework to say, okay, I'm in a high potential shop market for mortgages. I'm bound to put my mortgage specialists in that shop, or I'm in a high potential high performance market for small business activity. I may move my small business banker to those locations or put them on a much more concerted routing to those locations. So it's you really got both sides of the equation taking place when we do efficiency work for clients. And they do work hand in hand because I think you can't start reprocessing, changing around all your processes looking for savings without matching that to what the customers are actually doing with your organization or what you'd like them to do with your organization, and then making your branch footprint more amenable to those types of efforts based upon how well they can leverage the potential that they have in their marketplaces. So two gigantic efforts underway underneath to help this organization master what it was going to do. And the fundamental takeaway is put the customer in the center of the organization. I know this can sound somewhat trite as a cliche, but this organization actually went through the process of moving the customer to the center, both on the front and the back end, and then restructured its management and its processes around the culture, looking to align the business model, right? Through access to the experts that were appropriate, where and when by location, and then being able to deliver products and or engagement messages more effectively and better through the channel as they watch the customer experience materialize. So it was this was an 8-month, 9-month engagement for the client. It led to a gigantic long-term plan for them to help realize what was up to our initial pass was probably 30 million in savings if they were to do everything today, and realize some sales opportunities. Now, I don't recommend that. That's a lot of change for an organization, particularly an organization this size. But what we effectively did is laid out the roadmap over the next 36 to 48 months for this client. So, and these are some of the actions they took up, right? They began to simplify the hierarchy and the processes around the customers. That example I showed you around the loans. They restaffed the branch, moved to universal bankers, and then are training and tuning the branch based upon activity and the opportunities around those branches. Continue to decentralize the activity, the call center activity in particular, and increasingly the cross-selling activity. That cross-selling activity was further directed to train sales staff, which they were increasingly routing into the locations with the highest potential. So the first pass, they took advantage of. They saved 10 million in annual operating costs through this move. We uncovered I'll call it about 2 million in additional new revenue simply from low-hanging fruit, from improving your throughput rates with the existing demand to what we typically see, because they were below peer in those numbers. and then upping the branch utilization rate from 23% to 59%. So a good first step in the process. I'm happy to report the client has been busy digesting all of these changes and is ready here in the next part of second half of 2026 and the out years to continue down this road. So it was a worthwhile endeavor for them in terms of having help laying out what to do and the why to do it and focusing it around the customer. So again, if I had to offer you, kind of wrapping up here since we don't have any questions and we're getting on to time, I think. Um, uh, some questions that you can go back and do yourself, right? Start with the obvious. Is your efficiency ratio over 65%? Does it costing you 60, 70 cents to make that dollar's worth of revenue? If it is indeed the case, then you have an opportunity to go down this efficiency journey and look for some tremendous opportunities to improve both the processes and the expenses associated with the processes, but the way we engage with the customer as well. Then I start asking yourself the questions, what's the quality of your customer experience? Have you experienced as a customer what it's like to try to get a loan through one of your digital channels or the call center or the branch? This is unfortunately not done as much as I'd hoped at community financial institutions, but it's something that you can put together a small team of people to begin to uh, shed some light on it. And then you'll find, of course, that there will probably be wide quality phenomena across your various delivery channels. Which one is delivering the best customer experience and why is valuable to know. And then actually going through the exercise where what do we want the customer experience to be in each delivery channel is a natural exercise that comes out of that. So, and then what happens when the customer uses more than one channel? And I'm not sure how many of us have that kind of insight, but the typical case is, particularly with the younger generations, is they will start whatever they're doing digitally or mobile, encounter a problem, then bring a human into loop either at the branch or at the call center to try to solve that problem that is either a friction point or something that derails our arduous processes. Can we begin to understand what that's doing to our organization and have it digested across the silos and understood, and then create a plan to do something about it? Okay. And then the other thing that I think is that this ultimately drives to, if you recall that giant roadmap of adding channels and siloing the talent, one of the things that emerged from this study, which was a learning for us, is beginning to treat your channels as a delivery ecosystem rather than separate channels. I think has a lot of value, particularly as we spin completely into what we'll call the fully mobile, fully digital, mobile wallet driven, oftentimes now AI banker driven environment that the next generations are going to be facing. Being able to bring together our delivery channels into a cogent ecosystem through a digital strategy is, I think, going to be an exceedingly important phenomena going forward. So the other way I would end this then for folks as because we're running up on time is all of this is encompassed, generally speaking, in a larger digital strategy discussion. The efficiency discussion tends to bleed into a digital strategy discussion. Well, I think you can't separate them anymore. You don't have your digital strategy over here along with your efficiency strategy over here anymore. Increasingly, digital lays on top of both the front and back end of our strategies, and as a set of lenses, we pass everything we want to do either in the front part of our business, as well as now increasingly in the backup part of our business, through a digital prism. So that'd be the other takeaway, that as you start to explore efficiency, it's going to cascade into what your digital strategy is. I think the best thing you could do is move your digital strategy to the focal set of lenses that you look all of this through, rather than trying to treat it as a separate appendage. So
Fabio,
that is the highlights of everything. Yes,
can I ask a quick question?
sure.
So, when you folks are in there and you're analyzing the operation and proposing and institutionalizing new processes, how do you guys manage the kind of the human element, the cultural shift, so that those that are there, become empowered by it, not threatened by the change?
Yeah, this was a big issue for the client culturally. Um, and this is really then becomes a separate leadership training effort, depending on how well the organization's leaders are adept at managing change. So what we did here is that we did this literally from the top down. The board was exposed to our efforts. In fact, the board was driving the request of the senior team in this case. So that made a lot of effort, but you begin building momentum for change through the top of the organization. And then we actually stay involved, almost coaching the leaders as they began implementing these changes. So that's a key component that I don't necessarily have overtly spelled out here. But yeah, you're going to start changing the culture. I think you have to be very clear about the why around changing the culture, and gathering some feedback as you're examining your processes, right? You will have champions inside your organization who are heroically ramming people through the process that's been set up with the full knowledge that they know there's got to be better ways to do this. I think bringing them into the analysis and into the discussion where appropriate was also very helpful. But you're spot on, Jess. This can't just be a top-down thing. It starts with a top-down thing, but you can create momentum through to begin shifting the culture, and shifting how the culture uses the technology, for sure. Great question. Great question.
Thank you.
And I think,
I think that's it.
yeah, that is the last slide. Yes, indeed. We have just a few minutes left. I didn't do too bad. I spared everybody an extra 10 minutes. I would offer the folks that are on the call here today, if they have any other questions or comments, I'm happy to explore this further with your institutions or yourselves individually. You'll have my contact information here, but if there are any other questions, please feel free to just open up the chat or can they take themselves off mute and talk?
Of course. Yep.
Yeah.
Yep.
Okay.
Anybody can do that. And
Yeah.
just while we're wrapping up, and if others come in, I'll be quiet. Just a reminder, Engage will get this recording around. They'll get the deck around. You can always contact us too for information on Engage FI, and we can get you in touch with them as well. But yeah, really appreciate a lot of good information. Obviously, something that is very, very, very much on the minds of our leadership. And I even had a few thoughts as the association embarks on our new 3-year strategic plan. But yeah, really appreciate you guys doing this, and you did a great job. And
Wonderful. No, always happy to talk about these important things. As you mentioned at the beginning, Jess, I traffic a lot in the board suite and C-suite doing planning. This issue has leaped to the forefront,
yep,
in many institutions, because of all the other forces at play, not just the ones we talked about. You got AI strategy needing to be developed, data strategies needing to be developed, and increasingly you're seeing your infrastructure not keep up, and then growth is slowing for the demographic changeover. It's a real recipe that says we've got to bring this all into focus.
and the M&A.
Well, in all candor, that's what's driving much of the
Right. Yeah.
Okay, is clients are realizing this, and then are faced with a choice. What do I do?
Yeah.
So I had several of those very difficult conversations during planning sessions, increasingly over the last year. So, and I'm very passionate about the role that community FIs play in the economy and in the communities. I started as a community banker, many years ago. I am very passionate, as we all are at Engage, to ensuring their future viability so they can continue to fulfill that role of getting capital, local capital from savers to borrowers to support the communities they all live and share.
Well, thank you very much. We appreciate that and appreciate this. And I wish everybody a good afternoon.
Yes, thank you very much, everyone.
Bye.
Bye.